Yes, today I want us to look at ratio analysis. Ratio analysis. Remember, we've learned how to analyze financial statements. So after that, the next thing I want us to look at now, we want to look at some elements of the ratios that we can use to analyze the financial statement. So let's do some ratio analysis of the financial statement. The first one I want us to look at is liquidity. Let's look at liquidity ratios. These are ratios that we use in analyzing the ability of a firm to meet its short-term obligations. So if you are a stakeholder, you're picking up the financial statement, you need to analyze, you need to ask yourself, is this firm able to meet its financial obligations, especially in the short run? By short run, we're looking at within 1 year. This is very important because no matter how rich the organization as a whole may be, if they are not able to meet their financial needs, they will close down. That's the truth. You may be worth billions, but maybe your financial obligations run into just 10 million, and then maybe you don't have liquid assets. If you don't have liquid assets, it means you will still close down because you will not be able to meet your financial obligations. Now, how do we do the analysis? The first liquidity ratio I want us to look at is what we call the current ratio. This current ratio is simply current assets all over current liabilities. Current assets all over current liabilities. Now you ask yourself, where do I get all of these to do my analysis? The current assets are found only in one place. I mentioned all the financial statements for you. There's statement of financial position, statement of profit or loss and other comprehensive income, aka the income statement. There's statement of cash flows, and then there's statement of changes in equity. And of course, we have the notes to the account. Now, if you want to get the current assets, the first place or where to go to is the statement of financial position, which we call the balance sheet. So if you go to the statement of financial position, you'll be able to see a category of assets called current assets. You also see some others, another category called the non-current assets. So you have the current assets, you have the non-current assets, okay? And then all of them will give you what we call the total assets. So when you add this plus this, you have this, okay? Then you have what we call the total assets. So you will get this. Now, which one comes first? If it all depends on the kind of organization. If it's a financial organization like a bank, then the law expects that they should show their current assets before the non-current assets. If it's like a construction company, they are going to show the non-current assets before the current assets. But in all, they are usually categorized. So you will see the current assets, you see a list of current assets, you see something like cash, you see inventory, you see prepayment, you see all of that. You see, all of those are what? They are current assets. You will see them listed. So you pick all the current assets and then you go to also what we call the current liabilities. Where do you get the current liabilities? You also get them in the balance sheet. That is a statement of financial position. Also, you will see another place called liabilities. You will see the current liabilities. You also see the non-current liabilities. Okay? Now, when you see that, they're usually with the equity and liabilities segment. So once you get to that segment where you have the equity and liabilities, you go to the liabilities and you bring out the current liabilities. So this will give you an answer. So if you have something like 2:1, this is the ideal. It means you have more current assets over current liabilities. In some cases, if you have 1:1, it may also be acceptable, but it depends on the industry and it depends on you making the decision. So there's no straitjacket rule that says it must be this, but it is generally agreed that this is the ideal. But if it is 1:1, but where you have more current liabilities than current assets, then that is a red flag. It means that company is having liquidity issues. The next one I want us to look at I want us to look at number 2 of the liquidity ratios. The second one is what we call quick. We say quick ratio. And we also call this asset test ratio. Now, this is also current asset, but this time around we are removing something from it, which is the inventory, all of our current liabilities. Okay? So, for quick ratio, we do exactly the same thing that we did for current ratio, but in this case, the current asset, we have to remove something from it, which we call inventory. So you are getting it from the same place, which is from the statement of financial position. That is the balance sheet. You are getting it from there. And when you go there, you will see inventory. Inventory is stock. So now this asset test ratio is highly recommended for companies where they have a slow pace of movement for their inventory. I'm talking of companies where inventories are not easily disposed. For example, maybe you sell something that takes like 2 years to sell one. There's stuff like that. If you have that kind of inventory, that takes a very long period, between 8 months to 2 years to dispose them. So you have to remove them from your current assets, so that, because you're checking for liquidity, and if you don't remove the inventory, it might be misleading. So to do this for quick ratio or asset test ratio, we need to get the current assets, remove the inventory, and then we'll divide by the current liabilities. So usually, if you're able to get 1:1, we say it is acceptable. If you get anyone higher, it's also acceptable. We basically want to be sure that we have more current assets taking care of the current liabilities. So this shows that the company is not going to have liquidity issues. Now, the third type I want us to look at is what we call the cash ratio. The cash ratio here, the cash ratio, we're looking at cash plus cash equivalent. All of our current liabilities. Good. Now, when we say cash, you see, the first one we looked at the current ratio, isn't it? Some will not call it current ratio. Some will prefer to call it working capital ratio. What is working capital? Working capital is simply your current assets less current liabilities. We went ahead to look at a situation where you have inventory, and this inventory are slow moving. So we had to remove inventory from it, which we call the asset test ratio, or we call it the quick ratio. Remember, we're all looking at liquidity. Good. Now we want to look at the third one, which is called the cash ratio. Here we are concerned about cash, but we're able to add something that we call cash equivalent. Now, if you ask me, what do we mean by cash equivalent? Cash equivalents are simply those assets that can be quickly converted into cash under 3 months. Under 3 months. You are not looking at 1 year for cash equivalent. You are looking at 3 months. So if you are able to, in other words, they are as close to cash as possible. Something like treasury bills, you can easily convert it to cash under 3 months. So for you to get your cash ratio, you say all of the cash which you have, where do you get it from? You get it from the statement of financial position, which we also call the balance sheet. So when you extract your cash value, then you have to look at all those items of cash equivalent. Basically, the rule is you look at the ability of that asset to be converted to cash under 3 months. So if you have items like that, the best example I can think of right now is treasury bills. If you have treasury bills, it is a cash equivalent. And there could be other financial instruments that can be easily converted to cash. So if you have this cash equivalent, you add all of them together to cash, and then you divide by current liability. That will give you what we call the cash ratio. So if you enjoy this class, I want us to keep doing this. The next time we're going to look at another category of the ratio analysis, so that we can analyze financial statements like professionals, and basically not just to analyze them, but to make the best decision Remember, the rule stands for every financial statement you analyze. Check for growth. You look at the previous year, or you could even look at 3 years behind. You could look at year 1, 2, 3, 4, 5, depending on what you're trying to achieve. But look at some previous years. So you are doing the analysis, you are looking for growth. You look at some items in the financial statement and ask yourself, are they growing? You could look at profit. You could look at net profit. You could look at gross profit. You could look at revenue. Is there a growth from the previous year with this year? Have the revenue grown? You can do all of that. Okay. You can also go to the balance sheet and also check for growth. All of this is very, very important. But most importantly, know the financial statements and know what they stand for. Know what they communicate to you. The statement of financial position is communicating financial position to you. This is where the company stands. This is how rich the company is right now. This is their financial position. That is the work of the balance sheet. The income statement communicates performance for the year. That is what it communicates. It tells you the performance of the organization for that year. That is why we say for the year ended. We don't say as at. We say for the year ended. So you check for performance in the income statement. Now, if you want to know about cash inflows and cash outflows, you want to know what they invested cash in or what they use for their operations, the cash used for operations, or you want to know the cash that they use in financing, then the place to check is the statement of cash flows. You want to know the cash that came in and the cash that went out. You are checking the statement of cash flows. Then if you want to know the equity profile, whether there's an increase in what shareholders have put in the business or whether there's increase in retained earnings, which belongs to the shareholders, or whether there's a reclassification from one reserve to another reserve, all of these is very, very important. The place to check is the statement of changes in equity. And then lastly, I said you check the notes to the account. Never underrate the notes to the account, because the notes to the account, they explain things that are inside the financial statements. They explain things that you may not be able to understand until you read the notes to the account. Also, the notes may have some disclosures that are mandatory. They are made mandatory by standards, by statute, but they cannot be put in the body of the financial statements. So they are, the only place you find them is in the notes to the account. Okay, I want you to subscribe, I want you to like, and I want you to share this information so that we can increase financial literacy in our society. My name is Echala Okori. Keep a date with me.